Okay, good afternoon. Welcome to sunny West London. Thank you very much for joining us for this final in a series of three webinars about the UK leaving the EU, end of transition period, the 31st of December, implications for global trade, and a little lively discussion about what's going to happen with the new Biden administration coming in from the US and the implications on world trade with Trump's trade wars with China and the EU, amongst other things, plus a little bit of impact on COVID-19 on global trade, as if leaving the EU wasn't complicated enough. Today we're going to be joined by some fantastic guests. Richard Quantrill from our mtxpress, who's going to be talking about foreign exchange issues. Sebastian Barillot from Whysebird, who's going to talk to us about supply chain issues, especially in the luxury fashion industry, not just around the EU only, but also the wider global economy. We're proud to be joined by Nick Farmer. Thank you very much, who's a partner at Menzies, and they're specialist on international trade. And our good friend, Nauzar from Branduin Business Support. Today, we're also proud to be sponsored by Hounslow Council and Branduin to put this on as a final webinar in the series. So there's been an awful lot talked about where we are with these trade negotiations with the EU. We were going to have a deal. That deadline has passed through, and then another deal deadline has passed through. Lunch has been had and dinner has been had between the leader of the EU and our PM. I'm not sure whether that dinner was roast beef or sauerkraut, but one day we'll really find out. At the end of the day, everybody's still talking, which means something is there to be done. Ultimately, we really need to understand what the implications are for all of the people who are involved in international trade, and what the implications are for our own local economy here in West London. So first of all, to present, I'd like to ask Sebastian if he could please put on his camera and take himself off mute.
Hello, Alan.
And to have a presentation about the global supply chain. Sebastian, welcome. Sebastian is a Londoner currently, although originally from France. You might guess that by his accent. However, he's broadcasting to us today from another part of the EU, Ireland, our brothers over there. I can't help but ask you a question before your presentation starts. When you drove down the M4 over the Severn Bridge and across all of South Wales, and you finally got to the port where you got on board your ferry and sailed across to Ireland, did you see many fishing boats on the Irish Sea?
That's a hot topic at the moment, Alan.
I know. Anyway, over to you for your presentation. I'm going to turn my camera off and mute myself while you go ahead. Over to you.
Thank you, Alan. Thank you for having me today. So I'm going to share my screen and present you, as Alan said, some insights about supply chain. Okay, so that's perfect. So thank you again for having me. Great opportunity for me to introduce you to some concepts and ideas about the post-pandemic strategies. So as Alan said, for many months and years now, we were reflecting about Brexit, how we're gonna manage that, and then suddenly COVID came into the game. So I'm gonna focus more on the impact of COVID and how brands in the fashion and luxury supply chain have adopted strategies to move forward. So maybe before starting, let me introduce myself. I'm Sebastian Barillot. As Alan said, I'm French. I worked for the last 7 years for Burberry as a senior leader in the quality and engineering department. And I worked in the fashion and the luxury industry for the last 17 years. And I started my company this year named Whysebird. And just to give you a little bit of context of what we do at Whysebird. So basically, the umbrella, the main thing is people. So how we can elevate technically knowledge of people and on brands and startups. So we have one of our business units, which is focusing on supply chain expertise in the fashion and luxury world, but also how we can pass on knowledge and share codes about fashion and industry, the fashion industry world while lecturing in different universities. So we do that today in France, in the US, and in the UK. I'm also a business coach, so I'm also interested in how I can help people in different industry, in banking, in jewelry, for instance, so some of my clients, how I can help them to get better results and faster. So through model linked to neurolinguistic and apply to business coaching. So that's also one of the specialty we developed at Whysebird. And the last one is around motivational speeches. And I speak around leadership, entrepreneurship, and collaboration, for instance, different values, different set of values, different topics to help people to go through this pandemic and also achieve faster, better results. So having said that, let me give you a little bit of context around luxury. Maybe some of you are familiar with this world, some are not. So let's start on setting the scene. First of all, luxury is emotion, is driven by emotion. And luxury is an identity. So brands have a strong DNA. Every brand starts from somewhere. In the case of Burberry, for instance, Burberry started as trench coat company. So they are strong identity. The trench is produced in the north of England, close to Leeds. So this is the strong iconic product, and it's declined in different versions, as you can see on this picture. Some brands like Vuitton started with luggage. Some brands like Hermes started with horse riding and all leather goods associated to horse riding. So every company in luxury has a strong DNA. So identity is really important. And one key feature also of luxury is that luxury has to be rare and everywhere. So that's a bit of a paradox, but that's where you create, this kind of need, and people really want to get those products, and then they need to be accessible. One key thing also to understand the environment of luxury is to understand how it's structured, how it's segmented. So think about this. Luxury is defined by its high level of quality of material and its newness. So there are two axes. And in luxury, we can split the world of luxury in two. One, which is more focused on heritage luxury. Heritage luxury will be brands that work with the most premium materials, not so much innovative in terms of newness, but strong in terms of carry forward materials and products, like iconic products that are repeated for years and years and years. So you can think about brands like Chanel, Hermes, or Louis Vuitton, which are really heritage, really strongly branded as a heritage luxury brand. Having said that, you have this level of quality, and you have other brands who are more playing the card of newness, stimulating the customer with different drops that we call during the year, with small quantities of particular products you can buy and purchase, or collaboration with different brands. So the approach of those brands are more focused on creating new products, stimulating the consumer. And that's what we call fashion luxury. Fashion luxury will be brands like Gucci, Prada, Burberry, that always innovate in terms of merchandising, in terms of new type of products. They will launch new collaboration quite often during the year. So those are the two different segments of the luxury world. Below that, we have what we call premium brands or luxury affordable. Those are brands like Michael Kors, Lacoste, or Polo or Ralph Lauren, for instance, there are plenty of them. Those brands are not luxury. Those brands are just underneath the limit of the luxury world. They have less premium materials, and they are not as innovative in terms of newness like Gucci, Prada, and Burberry. And the price point is much lower. So it's important to differentiate the environments. So what are the post-pandemic strategies that those brands in luxury and fashion have adopted? First of all, what have we faced in the last month? So the impact, think about that, 3.5 billion orders have been canceled. More than 2,000 factories have closed. 4 million workers have been affected. Practically, for brands all across the globe, events have been canceled. Fairs where we source the materials, where we launch our new products, where we meet our partners globally in Paris, in Milan, in Shanghai, in different regions of the world, all canceled. No more fashion week. So we had to rethink how we were doing that. In a digital manner, in a different manner, there were several options to that, but that was the hard stop. And we had also to stop any business trips. Closures, stores. So what is interesting is that COVID started to hit Asia in January, February. But before that, there were the riots in Hong Kong. There were like some protests in Hong Kong in July. So for a brand like Burberry or Gucci, Prada, or LVMH that sell in Asia, we already had like 6 months of loss of sales in Asia because of the strikes and demonstration in Hong Kong. Then on top of that, so our stores were closed, people were not traveling in those regions. So we had a massive hit at this time. Then started in Jan, Feb, the closure of stores and headquarters in Asia. And then came to Italy and in the UK. Headquarters closed. All the operation of those brands shut down. So when I talk about operation, it's the whole chain. Think about all the supply chain, from the brand to the vendors who are making the product, to our suppliers, our stores, everything shut down. Of course, when we talk about closures, there's a direct impact on finance. So loss of revenue, a lot of orders canceled that we saw, and also for the operational part, all budgets were frozen. And finally, something which is really important is how we deal with our people during this period. Anxiety has reached like high level. People were isolated alone or with kids or far away from their family. So the level of anxiety went to the roof. Then we had to cope with new ways of working from home for some people, feeling like grounded, when some of like more on the ground people who used to travel and visit all suppliers, vendors, or going to shop from one day to another, had to stay at home. So how do you manage the expectation of your team members? And above all, how people will appreciate and how people will have trust in their organization. How will my organization will go through this episode of pandemic? Are we strong enough? Are we solid enough? What will happen to me? What will happen to the organization? So those were the topics we faced. And above that, Bain published this study in a few months ago, saying that the luxury market is likely to lose between 65 to 75 billion in sales this year. So you can see it's a massive hit that the industry has faced. The particularity of Burberry is the financial year of Burberry runs from April to March. So when COVID happened, we were in January, February. So we had only 1 month or 2 months of activity to close our fiscal year. So we were in a position, Burberry was in a position that was really, really tough compared to the competition like French brand or Italian brand that would have the whole year until December this year to recover potentially from COVID. So we had at Burberry to really put actions and plans really quickly because we had only a few months before the end of the financial year. So what was the recovery process? First, and that apply to Burberry, but to many different industries. The first message was safety as a first priority. Safety of our workers, safety of the team members, safety of the people in the supply chain, our suppliers, our vendors across different regions. Secondly, was how some brands have switched their production tools. What happened in the, as I said, we have the factory, Burberry has a factory in the north of England, close to Leeds, producing the trench coat, and how we stopped some production to develop and produce masks. So you don't press a button and in one day you produce masks that are certified. You have to go through a whole process of certification. You need to acquire machines, you need to train people. So all of that takes time. Then you show agility and you make sure that your factory is running and is also serving, then supporting the NHS, for instance, in that case. Then we had to reopen sourcing offices. So we mainly source and buy materials and products in Asia and in Italy, Hong Kong, and close to Florence. So the recovery also was to how we can reopen, linked to the first point, in a safe manner, those regions, knowing that those regions don't operate at the same speed. Sometimes Hong Kong will open and shut down before Italy, before the UK. So how do you coordinate all of that? And how do you ensure the security of your employees and of the people in your supply chain? Another point was also to look at contingency plan. So Hong Kong, as I said, was the first region hit. So we sat with our different operation teams to think where we could move production. If we had production in China, where China was one of the main regions impacted, could we move production in other regions like Indonesia, Vietnam? What were the conditions? What were the target price? What were the minimum quantities to consider? Was it flexible enough? Was it possible to keep on running orders we had at that time in February, March? So this logic we applied in Asia, we applied it a few months later in Italy with like other regions, like in Spain, Portugal, or Eastern Europe, to make sure there was still orders flowing in the pipeline. The engagement with the supply chain also is crucial, because what brands go through, all the supply chain is going through at different level. So that's a chain, and there's an implication also for them. So I think in time of crisis, just engaging with your partners, your main partners with whom you have a strong partnership, showing them that you will be here, whatever happen, if they have some financial difficulties, if there's uncertainty, the brand will be here and will be supporting them, because it's a teamwork, you know. So when you do that, you engage with your key partners, you do 70% of the job, and understanding what they would need, what would be their particular need in this time. If you could provide them any support in a way or another. We had also to review the business KPIs. So basically everything was stopped. So what were the key business projects we had to put on hold? What was the impact in the short term, mid-term, long term? What we can't stop, what we need to reprioritize. So we had all those discussions also to assess priorities around projects. And also something that we did a few months ago, before COVID, because of Brexit, was to push digital. So in the fashion industry, the particularity is that designers want to see products, want to touch products, want to visualize and have products in the hand, touch the materials. So it's, as you can understand, you need to do a lot of iterations. Once you produce a t-shirt, you need to first do a first prototype, a second prototype, a third prototype to approve everything. Then you do what we call grading. You ask for all the sizes, and then you validate for production. So as you can see, it has a lot of time, a lot of money, because you have a lot of samples to produce, and you have to ship those samples. And what we started to see a few months ago, a year ago, 2 years ago, is the rules are changing potentially with Brexit. So there will be new rules. So we need to train all the custom teams. at Burberry level or at different brands level, at supplier, at vendor. So it will slow down, but also there will be potentially a cost. So to mitigate that, we started to develop digital prototyping. So basically we recruited people from the university in England, and we started to develop a small digital team where people, this team of 2-3 people, were making prototypes digitally and showing to our designers how the prototype will look like before producing it. So it saves us money because we don't need to ship and produce the prototype, and it saves us also time. If we take an example of a prototype with a print, we can adjust the print wherever we want until the designer is happy, and then we can start producing the first prototype without doing 1, 2, 3 iterations. And also what we had to do in the recovery phase is to rationalize budgets. So in time of crisis, you focus on the basics. And as I said before, everything has been frozen. So it's how you can do more with less. So linked to business review, prioritization of budget was a key question. But most important, and I kept it for the end, is how during this time, like we've done with our supply chain, how we are closer to our people. How do we listen to our people? How do we follow up with them? Most of my work from February until September was to call my guys in Italy, call my guys in the UK, call my guys in Hong Kong to see how they were going, because things are moving at different pace between Italy, France, UK, Hong Kong. And as a leader, you have to be there for your team members. You have to make sure they're comfortable, they have everything they need, and the environment is safe as much as possible. So this is the recovery phase. And what we've learned from this recovery phase, there are a few things we've learned. First of all is agility, is how when something happens, you can switch your production tool and adapt to the demand and create new products. So I talked about Burberry and the example of the trench coat factory that completely switched to mask production mode. But I have also the example of this French supplier named Chargeur, which is a big supplier that produced interlining. Interlining are materials that we don't see. Basically, they are reinforcement material that you can have, for instance, in a tailored jacket. And this supplier is supplying materials to all the industry. COVID happening, there was a massive reduction of orders. So what they've done is they stopped their factory and they switched to producing masks. And nowadays they have produced for a value of 150 million euros of masks. So they basically created a new division, which is a mask division, and they've shown us how responsive they were and how agile they were and how they spotted an opportunity, and they made sure that their company went through the COVID period in the best manner. An interesting thing also resonating with what Alan said is how we communicate in time of crisis. Where do we put the cursor? How global is our message? What I'm saying by that is that when I was at Burberry, Burberry is an English company, and our communication team always talked to our team members, to the company from the English point of view. But think about it. There were like different waves. When Hong Kong was under COVID, we were not impacted yet in the UK. Neither was Italy. So we were thinking to move all the production to Italy. Then 2-3 weeks later, Italy was impacted. Then France, then UK. And then it was this kind of cycle. So it's really important when you're in time of crisis to not think only from your headquarter point of view, but make sure that your message really engage all team members that can be at different stage and experience different level of stress or different phases. Could be under lockdown, could be lockdown just lifted in some region of the. So it's really important to think and to really consider to have a global message, knowing that all regions may move at different pace. The other thing we've learned is also, it's more like here the coach and the business coach, let's say, is that in terms of crisis, or when things like this happen is first to be, as we say in English, being at home with ourselves. Let's pause, let's reflect, look at what happened, act and learn. So basically, if I want to take care of the brand I work for, if I want to take care of my supply chain, if I want to take care of my team members, first, I need to take care of myself. I need to be good with myself. Example, for instance, when you're on a plane and there are turbulences, the masks are dropping. You're not running after your kids or after your partner to put the mask first on them. First, you take care of yourself. It could be selfish, but if you want to help others, you have to be good with yourself. You have to be comfortable so that you can take care of other people and you can lead people through confusion and uncertainty. And that's the role of the leaders, especially in this time, is to make sure that things are clear, as much as clear as possible for our people. So we have to reflect, we have to pause, we have to think, and we have to act and learn and make things clear as much as possible for our people. Finally, I'd like to take a few seconds just to talk to you about the future strategies that we have moved on. First of all, is around supply chain optimization and how we said increasing partnership, not with everybody, but with key targeted partners, making sure we're here, we're supporting them, we understand what are their needs, and moving to more agile model. So we have demonstrated that as a brand. Others as suppliers or partners have demonstrated that, how we can push that even more. Another thing is also to think about the new normal. We knew the old times, how we were working, the old model. What is this new model we're going to tend to? How we can get there faster? The new model doesn't mean it's completely different or it's exactly the same. It's different. There are things that will stay, things that will change. How can we adapt to that? How can we get faster? How can our team move faster to this new model? What do they need to be more efficient and faster? So this is the kind of discussion we had also with our people. In this new world, with these new rules, things stays, things last, things change. What do you need to be better and move faster to what you need to do? How can I help you? Then another thing was around digital acceleration. We saw that we validated the fact that we use digital sampling. So it was a concept, it's been a pilot during Brexit, and it's been approved during COVID. So now we are gonna move to more and more digital sampling. And with Brexit, that's gonna be for sure becoming a best practice. And then how we can use more data. So how we can structure more our data, how we can collect data, how can we gather all the data in one central location, and how we can be smarter in the way we use data. And also an important feature, I was invited as a guest speaker a few weeks ago, and there was someone from Facebook who was here, and this lady explained that e-commerce today reached the point that it was supposed to reach in 5 years. So there was an acceleration in e-commerce. So e-commerce is not to be validated or is not to prove anything now. We are there, and it's a model that we need to that is being approved and is going to be pushed even more now. Another point will be also how we can prepare better our leaders. As we saw, most of what I've done in the last weeks and months with my team was how to listen to them, how to support them, and basically using soft skills, being more able to face change and develop more leadership skills. So how can we help our leaders with tools? How can we train them? How can we help them to face those challenges? And linked to that is around well-being. So well-being is going to be seen as a mega trend in the coming month. So well-being of our people, how we work from home, how do we have an environment that is comfortable? How do we make sure that our people work in this hybrid model, work from the office, work from home? How can we help them to be efficient? And also, how can we manage our energies? Physical energy, spiritual energy, mental energy. How can we help people to be efficient? How can we help people to manage their well-being? Is going to be a critical question. And finally, this crisis, I think, help also to rethink and maybe reset how our industry is working. So there are more and more initiatives today to say, linked to a sustainable economy. Say, guys, one of the biggest issue we have in fashion and luxury is inventory, stock. What do we do with our excess stock? What do we do about our finished product stock? That is the question. Once we have this inventory, what do we do about it? Secondhand, reuse, recycle. But before that, how can we be smarter? How can we rethink our business model? So helping through AI, helping decision on forecasting, on production. So there is a time for reset and rethink the whole model to avoid creating inventory, because inventory is money, and all this money, if we avoid creating all those excess, that could be money we can use for sustainable initiatives. So how can we reset the industry? And I encourage you to look at different initiatives that you may find on the web linked to time for reset around inventory. It's really fascinating. So that will be it for me, Alan. So thank you for listening to this immersion in the supply chain luxury. I hope you enjoyed it. And if you have any question, I think there's a Q&A session later on, and we can stay in touch at whysebird.com, or you have my details on LinkedIn. I'll be happy to engage with you on another time on some other topics, or if you need a follow-up.
Fantastic, Sebastian. Thank you very much. You've got some very good comments in the chat boxes about people who are saying that they couldn't agree more with many of your comments. I loved your points about pause, reflect, act and learn, and help others. And this is absolutely a time for reset. It's a time when you're really busy, you put things up on the shelf as future projects that you're going to do one day when you get time and they gather dust. Now's the time to get them down and come up with those clever ideas and get new things to work. So thank you very much for your very insightful words today. So our next speaker, Richard Quantrill, is the CEO of mtxpress, who are one of the London's and the UK's leading foreign exchange companies, and also supply some business finance. Richard's been down to see Santander Bank this morning in London, in the city, and he's currently, by the look of it, self-isolating at the end of his garden in a shed where his wife has put him after his visit to the city. So Richard, please tell us all about what's going on in the world of banking and foreign exchange, and what the future is going to hold for 2021 now we're outside the EU transition zone. Thank you.
Thank you, Alan, and thank you, Sebastian. A very, very good start for sure. Let me just, I'm just sharing my screen. Give us a moment. Okay, thank you all. Let me just very, very briefly introduce myself. So my name is Richard Quantrill. My company is mtxpress, and let me just tell you what mtxpress does in very, very broad terms. We run global currency accounts, and what that means is if you can picture your standard UK bank account, we have an account that will run very similar to that, but it will enable you as an importer, an exporter, or someone who needs to move currencies around the world to receive that money in whichever currency, send money, hold and switch anywhere around the world. We started in 2008. We are now up to 140 plus actual currencies locally. So those are predominantly the G20 currencies, but also we have a lot of links with actual local and small currencies. So wherever you are in the world, Asia, Africa, South America, were able to support your business. Running alongside this, we have various financial solutions. So, for example, trade finance and various FX solutions, which I'm going to give you an inkling on as we actually move on. So, what I wanted to do is to give you a blend of what we've seen in 2020 in the FX markets, how the US elections have affected this, COVID-19 also, and of course with actual Brexit looming. So, as far as the US elections have run, we've seen that the Electoral College have completed their actual certification, and President-elect Biden has been formally recognised. There's a few scenarios to work through. The Senate is yet to be decided, but from our analysis, we can see that there's pretty much a 70% chance that this is going to remain Republican. Now, aside from the current president's Twitter feed, overall, everyone's viewed the election as having run smoothly and also accurately. But COVID-19 has had a great effect on the FX market, and this has been amplified somewhat by the actual Trump campaign, which really started, March and April, and somewhat, ignored COVID-19. So, what happened with actual currencies, and what happened where people wanted to put their assets, investments, and their money? Generally, in actual times of actual crisis, money is moved to safe havens, and we've seen a strong move to US dollar, Swiss franc, for example. This is where people see their money to be safe in times of when we're not sure of the outcome or can't see far enough into the actual future. And the result of that is the emerging markets, and this is Asia, this is Africa. We saw a sell-off of that actual currency, and then that move upwards to, for example, the US dollar. But now we are seeing a light at the end of the tunnel. And we can see, and we can start to be optimistic. We've seen a move now away from the actual safe havens, really prompted by the vaccine news, which is we hope to be to have good, strong rollout, certainly by the first and the second quarters of next year. The stronger currencies we expect to see and to improve the fastest are going to be those countries who have made the largest orders of vaccines from multiple suppliers, but have also those actual countries that have got a strong infrastructure, the ability to store, to distribute, and those actual countries seem to be tiered. Mainly the actual G8 countries, moving down to to Asia, Africa, and South America again. So this screenshot here is just a look at the analysis that we actually went through prior to the actual presidential election, and what we wanted to do here was to work through the various scenarios and how the result of the election was going to affect the actual global market. So the one that we can that we're focused on first of all is going to be the actual top two, and really the second option down we expect now to be 70% most likely. So that is with actual President-elect Biden. He holds the House, but he's very unlikely to hold the actual Senate, and this will demand a lot of actual cross-party negotiation and working together. But what we expect to happen is a lower trade uncertainty, and this will lower the dollar also, and bring it in line really to where it was two or 3 years ago. Now, one of the president kind of actual processes he went through was he spoke a lot about make America great again. But to do that, it was more of a push to suppress some of the emerging markets and particularly China. And the way he did this was with actual trade tariffs and actually pushing and trying to, as best he could, actually weaken their economy. And as you can see from this actual slide, you can see the movement down of the actual Chinese economy. Now, as we know, with President-elect Biden, we can expect less protectionism and more of an actual global approach, and that will flip the Chinese currency up. And I'm going to move to the and as we see this this actual move upwards, we can see the true strength of the actual Chinese currency. So what this will mean is for the importers or exporters that are actually transacting with actual China and certainly some other emerging markets, is that the common currency was the actual US dollar to actually trade, whether that's to be received or sent to those actual regions. The strength of the actual Chinese currency is actually following the actual dollar, and we expect that the actual Chinese local currency effectively to start matching that of the actual dollar, allowing that to be a potential future safe haven. So the safe haven currencies, as I mentioned, were the US dollar, Swiss franc, etc. It's very rare that another currency will move into that group, but we're seeing that with the actual Chinese currency. So moving on to onto Brexit. Clearly, Brexit has had a political, cultural, and immense economic consequences. We've seen sterling 15% lower than before the referendum. We don't expect sterling to recover still, whilst there's this uncertainty hanging over to us. It's very unlikely that the Bank of England are going to move any further. You know, the current interest rate is at 0.1%. The last push with quantitative easing is 895 billion. So it can be honestly say we're almost running dry of financial options, and we need to almost actually trade ourselves as a country out. So generally, recovery, as we've seen, is all about the actual deal, and we all know the how critical an actual getting a deal of some sort, and all of the customers that we speak with, whether importers or exporters, they're really now focused on that, knowing what their costs are going to be for for the next year. But we do remain very optimistic. We do expect what we term as at least to obtain a skinny deal from the with the actual EU, and that may mean revisiting the negotiations in 2021. But as we go day by day, we do confidence is building it, and we're starting to feel as if something a bit more substantive is going to be presented to us. So what I want to do now is just give a plan to potentially reduce your FX risk, improve cash flow, which will result in increased profits. What we find is when whenever we visit a new customer, one thing we ask them, and we say to them, please don't tell us the rate you're paying. We don't need any actual numbers. All we need to know is do you know what you're paying for every time you switch a currency, whether that's to pay an invoice or to receive money. And in all honesty, most of our customers initially don't, because they will they phone their bank to do this. They have an online service, and they don't have the time maybe to actually drill down to the actual numbers. So what we certainly recommend, and we actually first of all is to ask them to avoid any actual transactions that have administration charges, subscription fees, anything that's particularly unnecessary, and to ask themselves to be presented with simple figures. If I need to buy some US dollars and I have pounds, ask what the market rate is, ask what the FX charge is, and typically for an actual transaction somewhere between 100,000, 500,000, the FX charge should be around, on average, 0.312%. Knowing these actual figures will enable you to actually plan for the future, and actually plan your actual balance sheet to know exactly what you're paying. The next thing we come across is the terminology forward contracts. A lot of clients don't understand the actual process, only because it hasn't been explained clearly to them. And in this actual slide here, I'm just going to, if I can, just explain it very, very briefly. So the wavy line you see is the movement in actual FX rates, which has been amplified even more so in 2020. And a forward contract is a simple mechanism of you locking in a rate. It's important to say you're only agreeing to a rate. There's no movement of money at this early stage. So this will allow you to look at the that rate. It could be for a month, or you may want to have a locked rate for up to a year to enable you to clearly budget your actual business, taking care of your incoming and outgoing as well. The other solution that's often asked about, and even more so now, is trade finance, or as we call it, an actual trading advance, which is a simple solution to hopefully give your business some extra agility and also some actual cash flow. And actually, just to outline that, we offer the actual process here is offered to both exporters and importers, and allows you to actually bridge that gap between the purchase of your goods and the receiving of your goods, and then getting it out to the actual marketplace. Most importantly here, if ever you are taking these actual options, is to make sure that the choice you make doesn't have takes no collateral from your business and doesn't impact any of your existing credit lines, as it shouldn't. These are literally for actual bridging purposes, and the illustration here is just for again if you're an importer. So just some actual brief actual takeaways for you. Just really in summary, to expect the value of the US dollar to lower during the actual first actual quarter of 2021. This is the the President-elect Biden's effect, and as we expect the US to get a better grip on an actual COVID-19 and also their actual vaccine process. The emerging markets, their currencies, we expect to rebound strongly, particularly in Asia, and again the CNY, which is the Chinese currency, as actual President-elect Biden starts to relax some of the the enforcement that's been actually put on various actual reasons. The we expect to hopefully see the velocity in the FX markets to reduce by the second quarter. This, along with the Brexit solution and an actual deal, we expect to calm the sterling, the euro, and all those key G8 currencies. And then finally, just as you're operating your actual businesses, first of all, just to have a look and ask that actual question: if you are switching or currencies paying as an import or bringing in as an exporter, is just to ensure that you know what you're paying for your FX. To consider the forward contract option to help stabilize your costs. Have a look at trade finance to strengthen your business and help manage your actual cash flow. And if you look at the last three options, we would expect to and hope this may give your business a bit more agility and hopefully a competitive advantage. Most of our customers use a blend of these these actual options. And I know that we've got an actual Q&A actually coming up at the end, but aside from that, if anybody has any thoughts or questions they want to fire at me after this, my email address is below there. Alan, if I could hand back to you.
Sure, thank you very much, Richard. Very interesting. You've got a very interesting question that's come through from Tony Mulvihill. I believe Tony's from a local university, listening with some of his students in the background who all want a bit of an insight as to what's going to happen. And his question is, do you think sterling will reach parity or lower than parity under a no-deal scenario? Presumably he means parity with the euro, not the US dollar, I hope.
So I can maybe answer actually both that. So the scenarios that we are running with regard with actual no deal leads us to strongly believe that it will be lower than its that it's actual like direct peers, which will be the euro, US dollar. There's too many. There's a lot of actual variances. To give a very honest answer, we've tried very hard to understand and find out exactly what is in the deal as we stand. We know there's still items within the actual deal to be understood and agreed on. Fisheries, for example. Level playing field, which is what we're the UK is asking for. Having those actual questions answered, I think will actually settle the market. And as people within the market, they ask us all the time, what do you think? And we have to say to them very, very honestly, nobody's given us the true detail.
Okay, interesting. We're going to have this debate a lot more at the very end, and a proper full Q&A session. So Richard, for the time being, thank you very, very much for your presentation. It's very enlightening. Nauzar, would you like to come online now and give your 5-minute presentation, and then I'll wrap things up and have a more question and answer situation with Nick Farmer especially, who can give us a bit more of an insight as to what's going on next. And perhaps Nick will have a few views on deal, no deal, and exchange rates. I'm going to put him on the spot for that, but I'll let him think about it for a few minutes before we get to there. In the meantime, Nauzar, you're not quite on the screen at the moment. Here we are. Coming back again.
Good afternoon, everybody.
Screen and put your presentation up.
Okay, and thank you, Alan. I'm just going to share my screen now. So just give me a second. Okay, I've got about 5 or 6 slides, and as Alan put me on a quarter of 6-7 odd minutes, I won't be too long. Okay, just a couple of slides on who we are. We sort of, I mean, proudly say we're the leading group of business advisors in London and the Southeast. And the way we do our business is essentially we work with local government authorities, entrepreneur hubs, and regional enterprises. And we access their funding to work with SMEs in terms of startups, early stage, growing and established. We have different programs for each of them. The way we deliver is through key partnerships, and Hounslow Chamber is one of our key partners. We've been working with them for over 10 years now, and we have a group of business advisors and specialists, two of whom are actually on this call. I mean, we've got Tony Mulvihill, who works closely with us, and a new person who might be joining us shortly, Elsa Caleb. I mean, apart from that, there are quite a few other familiar faces in the participant list. So welcome to all. And just to add to this, at this point, I joined Branduin about 10 years ago, and in May, owing to certain changes in relationships and our business model, I was appointed for my sins the MD. Okay. So what we do, we have three key services. One is Goal Mapper, which is a business recovery program. It's a proprietary program. It's a trademarked one. The other one is Win More Contracts. We're working with HS2 and a few other key organizations, hopefully for next year, to implement our Fit to Bid one. We implemented a very successful as a pilot in the London Borough of Ealing across all of this year. And we have big plans next year to start a licensing or a franchising sort of a program. So much more on this later. I'm going to essentially try to build on what Sebastian said and to talk to you in brief about product flow and something which is interesting in terms of where we are now with Brexit, with what COVID's basically taught us, and what we need to do potentially in the next 2 or 3 years to bring our businesses back to shape. As an example, this is what most businesses do. We take from the environment, or we take from the economy. We make a product. Our consumers or our customers use it, and most of it goes to waste. And that's the characteristic of a linear flow. Most products take very scarce resources, and most of them end up in landfill. Landfill is a problem. Landfill is expensive, and landfill is also very smelly. So how do we try to get around that? We need to rethink our supply chain and what we're calling the circular economy. We work as a company, as myself individually. I work very closely with the Board of Innovation. They're a very innovative group of thinkers based out of New York. And we exchange emails and information, and we've come to the conclusion that we need to do something a bit different. And the Board of Innovation basically says where we should have a linear economy, we need to look at a circular one. And the circular one you'll see is essentially, it's got a few new boxes. I'll start with each of them. The new one is use. It would be ideal if we essentially started to manufacture our services and our products for maximum use. But we know if we produce something which is going to be used for a long time, that's also going to impact our revenue and our profitability. So that's a big challenge as well. Reuse and repair. Reuse and repair, a good example would be the pallets business in terms of reuse and repair. There's a company in the borough of Hounslow called the Pallets Yard. Unfortunately, Ruth Ann Lynch can't be with us today. But I worked with this organization for over 4 years now. And it's not something we see in the open, but they take pallets, they repair them, they buy and they sell. They are unknowingly, they are already part of the circular economy. The other aspect of it is if you look at a repair sort of a model, you're looking at bike repairs as well. That is a big opportunity in the economy. We know that the bike business is fraught with repair work. Some of it works, but it's an opportunity for organizations to build on a problem. Where it starts getting interesting is return and recycle, and this is where we believe that organizations, small or large, this circular economy is not just for large organizations. It's for it could be the basis of a startup. It could be the basis of an organization turning over 100 million. So return and recycle. A good example would be bottles, Coca-Cola and Pepsi and supermarkets as well. They are now looking at returning their key bottles for reuse. Where it gets really interesting is take and make. And take and make is essentially, it's characterized by limit what you take and the waste, and whilst creating value for all. So you're looking at recyclable paper alternatives to plastics. You're looking at creating value in terms of regeneration, or a generation of new power systems from waste. That, I believe, is going to be part of our future. That's what COVID will change. Is going to be part of the new sort of normal as well. The circular economy. Think about yourselves, how we're going to be able to do it. One aspect on waste is, if you look at waste, you're also looking at, if you've seen, I saw an ad recently by ITV saying that they're going to be carbon neutral by the year 2030. Now, that is a TV programming sort of a business. I'm sure they generate a lot of waste, but they've got a target to be carbon neutral, and that I believe is extremely laudable. Okay, we're not going to be able to do this on our own. It needs basically adapting your business model, as Sebastian said earlier, and developing key partnerships. A bit of a plug here. This is also part of a very popular sort of webinar which we deliver. So on the left, you've got two rectangular boxes, which are business models. One is yours, and the other one is potential one belonging to your partner. The other two triangles are partnership ones. So how do they basically fit in? How do you adapt and change your business model, creating a partnership one? And how does that affect the sort of a new circular economy? Well, as an example, again, building on what Sebastian said, I had no idea who's going to make that a presentation. So it's a bit of a coincidence, great minds, etc. Okay. And looking at how two models of two different partners or countries or continents can come together and create a sustainable sourcing kind of a model. Now, you might think, why is this guy talking about models and key partnerships? Because our business, the business which we are in, is based on clients and our key partners. I'm going to end with this one slide. Essentially showing you the kind of partnerships that we work with. We've come to the conclusion, going alone, you can only go so far. Going together gets you much more business, much more continuity. We work with universities, with University of West London. Again, Tony Mulvale is part of that ecosystem, which we work with chambers, we work with a few banks, and we are delighted to be here working with Hounslow Chamber and West London. So on that basis, this is the last sort of slide. Alan, I'll hand over to you. These are the three webinars that we sort of co-sponsored. And again, once again, many thanks for the opportunity, and thank you for listening to me.
Wonderful. Right. Thank you very much, Nauzar. Much appreciated. This is where I'm going to try and do my best to share a screen as well now. Share a screen and talk is often difficult, as I found out. And I think I'm starting to open this up. And Here we go. Right, hopefully that looks clear to everyone. So today's webinar has been all about getting a few key people to speak. Nick, I haven't forgotten you. I'm coming on to you shortly. We've discussed about trends in trade. We haven't talked about new standards. We talked a little bit about President Biden. What I'm going to try and do is quickly zip through some slides. One slide from the DIT today, which has come out. So I'm going to be putting this up on the feed afterwards so people can get these links. We've only now got a few more weeks to go before the end of transition. We've talked through HR, we've talked through e-commerce, we've talked through foreign exchange, we've talked and had a specific webinar about export documentation. And if you haven't got that message now, these are the screens that you need to click on to get there. One of the key things as well is if we do end up, and we will end up with our own tariffs coming through shortly, it's going to be called UK Global Tariff, UKGT. And if you click on those links, you can look up what your new tariffs are going to be once the agreement or not agreement's there. The one thing that I've said that I would say a few words about is about marking of your products that are going to be sold in the EU or in the UK. Currently, the regulation for everything is to have a CE marking. The new approach is going to be for us in the UK to have our own mark that will replace a CE mark. The good news is that up until the whole of next year, you will be able to sell goods in the UK that are marked CE. And there's going to be a slow handover period between the CE and the new UK certification, which is called UK Certification Approved Body. This will go on a sliding scale starting from the 1st of January 2021, which is the first day after the end of transition, and it will come into force effectively January 2022, where everything will need to be marked UKCA, and then 2023, for most goods you can affix UKCA onto the label with an accompanying document. The changes to the conformity assessment bodies for the new approach is we're going to have our own bodies from the 2022 in most cases. Also, the EU will, of course, still want to have their own product CE certified. And you need to check your legal responsibilities for this new approach if you have product coming in. But you don't have to do it immediately. Don't forget 2022 is when it's all about. Importers that you've got UK-based company with a distributor into the EU would become your importer and vice versa. Also, you'd have authorised representatives that are based in the UK or Northern Ireland for the GB market and authorised representatives through the EU. The legislation will come into force in the summer of next year, so look out for that. I picked this slide up from Niall Bolger, Hounslow Council CEO, talking more about the impact on our local economy before we reflect too much on a global economy. And as you can see, there's going to be a £1 billion loss to the Hounslow's economy over the next 3 years, potentially up to 43,000 jobs at risk. And this is all down to independent analysis from Oxford Economics. So that's my very short shift of a presentation. The key thing I wanted to do at this point is to bring in especially Nick. Hello, Nick, if you could turn your camera on, and also to Richard, Sebastian and Nauzar, if you could turn your cameras and microphones on as well. We can get into a little bit of a Q&A session. one of the first question, I'm going to throw this over to Nick. Will be pleased to know he gets to say something. One of the questions that's come in is from the chairman of our Chamber of Commerce, Chris, who worked for many years in the City of London in Lloyd's. And they deal with a huge volume of what's technically called invisible exports. And how do you see the UK's situation with those invisible exports? They've often managed to balance up our trade deficit of visible goods with that. And where do you think we're going to be, especially the City of London is going to be in the coming year or two with a hard or no deal at all Brexit? Was that a good question for you to start off with?
Yes, thanks, Alan, and thanks everybody for your wonderful presentations leading up to this Q&A. By way of introduction, I'm Nick Farmer. I'm an international tax partner at Menzies. We advise thousands of SME companies on trading internationally. In relation to Brexit, of course, you know, it's the goods that are getting the headlines and the ability for those to process cross-border as efficiently as possible. We can't get around from the fact that there is going to be a hard border here. You know, we are leaving the customs union, we are leaving the single market, so there's certainly a border that is going up as from the 1st of January. We know that's going to lead to additional documentation. Even if there's a deal in place, we can't get around this. I think a lot of businesses were hoping that a deal would solve everything. Certainly it isn't going to replace the status quo because, you know, once you leave the single market in the customs union, you're a third country at that point in relation to dealing with the EU. So there's change that definitely comes on the 1st of January. And so a lot of businesses have had to look at this and understand how they are going to trade. So clearly goods are going to be impacted here, and what documentation is going to be required from an export and import perspective, new processes, potentially new tariffs, ways of dealing with VAT. All of that has really sort of grabbed the headlines. We can't, you know, forget, of course, that the service sector makes up such a huge part of the UK economy. It's about 80% of the UK economy, and roughly it's about 50% of the UK exports. So it's a really significant part of our exports to the EU. We don't import as much in the way of services, and hence services are never going to be such a key part of the trade agreement with the EU. It's more us looking out to them and selling our services rather than the other way around. In relation to sort of financial services in the city, I think those businesses saw very early on that they weren't going to get the free access to the EU market that they've clearly enjoyed under the current membership of the EU. And a lot of our clients, whether they be in the financial service sector as insurers, FX businesses, anything where they need access to European customers to be able to transact with them, I think they could see quite clearly that they may well not be able to deliver their services from outside the EU to those customers. There's been very little mention of this in the EU trade negotiations. To some extent, it's a little bit sort of uncanny that everything's really focused around fishing, which I know is sort of a sign of sovereignty and is a very emotive topic. But actually, in terms of the sort of size of the sector compared to the financial service sector, you know, it's completely dwarfed by financial services and the value that that actually has to the UK economy. But we've seen very little in the way of how financial services are going to be included in any deal. And typically services don't get included in these sort of free trade agreements. They tend to focus on goods. Services have always been relatively sort of underrepresented. You might get details on data flow, etc., and sharing of data, but it's unlikely that services will form a key part of this trade agreement. And therefore, financial services, to me, have already made the decision. We've seen those businesses set up in the EU. They've established themselves there. They've transferred part of their business into the EU. We've seen a lot of banks go to perhaps Frankfurt. We've seen our clients go into places like Brussels, Barcelona, part of the mainland, to actually establish, transfer parts of their business, set up offices, and actually then be in a position to trade freely from the 1st of January. There's too much uncertainty for them at the moment to rely on the fact that something's going to come through in this trade deal. Very little, as I said, has been said about it. So those businesses may have already made the decision. They went, and they typically went some time ago, actually, in the way they reorganized themselves.
So do you think this could be a dramatic change for professional services and financial services from the City of London? Not just for the stock exchange, but for all of the different trading markets, the LME, the petroleum exchange, the diamond exchange, let alone the LIFI, the London Interbank Foreign Exchange market?
Well, not necessarily. I mean, the government clearly wants to have a sort of a strong financial services sector, and they are looking to deal more widely. So you may perhaps have seen in the recent deal with Singapore, but that is starting to go in that direction. And some of the agreements that we're going to put in place with countries that would have previously been dealt with under EU agreements, we will have a freer hand to look at how we include services in those agreements. And the businesses that have gone and set themselves up in the market haven't typically transferred all of their operations. They've just put sufficient operations into the EU so that they can continue to transact with the local customers and do business. But a lot of the business has stayed in the UK. It's often the back office functions that may have been transferred.
And Richard, are you seeing any movement on the foreign exchange markets of more traders going off to Europe? Because as I understand it, currently, more euros are traded in London than every other European city added together, and more US dollars are traded in London than in New York.
Yeah, so the first stage was, or the first signs we saw, and there were a few actual traders slightly ahead of us. So we're regulated by the FCA. We have seen the actual setup and actually partaken in the actual setup of the equivalent in the EU of that regulatory requirement. That was always the first step. So that was like a clear sign to us that that our peers, if you like, were moving part of their operation into actual Europe to allow them to continue to actually service the actual customers. We initiated this 4 months ago ourselves, to actually set up in Europe as well. Again, to keep that, all the channels open for our actual customers.
Which country in Europe did you choose?
Spain.
Spain, not France, not Ireland. Okay. Okay. So let me come back to you a second then, Nick, not to let you off the hook too quickly. A lot of talk has been about if some things are not agreed at the end of this negotiation, none of it is agreed. But people are still talking. And there's been deadline after deadline that's been crashed through. There's been much talk about the deal has to have been done 2 weeks ago before it can then go to each individual European Parliament, that each have to vote on it before it can then go to the European Union to ratify it, which then has to come back to the British government to then agree it. There's not time, surely, for us to finalise the deal. or are they all going to be signing a blank piece of paper, and in January a lot of the trade negotiators are going to be in the back office there somewhere with a candle around them trying to work out how they can type a deal up?
I think with all these things, where there's a will, there's a way. It could get pushed, to very close to the year end and ratified after the year end. Certainly, that is sounding like that, could be what happens here. I mean, look, there's a couple of key areas here, aren't there? Typically the level playing field is a big one. The EU are not willing to have a very significant economy on their doorstep that can sort of undermine their businesses by, having policies which give them a competitive advantage.
Historically, the UK hasn't ever been a country that has funded or state funded a lot of industry. So I don't see that necessarily as being a major issue.
It's not really state aid necessarily. It can be around policy, employment law, things like that, which potentially gives somebody a competitive advantage in the way that business operates. It's not necessarily funding coming from the government. And you're right. I mean, state aid is an aspect of these negotiations, and the UK has never really been an economy or a government that has actually given a lot of state aid to business. A lot more comes from, say, Germany, to its businesses. But there are things that obviously could be done through government policy and incentives that maybe, give the UK a competitive advantage. And the EU is sort of already talking about this evolution clause that could come into the treaty here that just gives them the right, if the UK does do something which is clearly going to create a competitive advantage for business, then look at how the response would come to that. So we'll probably see some mechanism in the agreement here that will sort of outline what would happen in certain circumstances if there is deemed to be a competitive advantage. Remember, this cuts both ways as well. The UK, in going into this agreement, if the EU does something, would also want to have the ability to, change under that agreement. A trade agreement is both ways, of course. This isn't just about the UK and getting what we want. We know that the EU are sort of, needing to make sure that, they also get what they want. So sovereignty, yes, it's a key issue because it was part of the Brexit campaign, wasn't it? Take back control. So you can't get around that. The UK need to be able to demonstrate that they have taken back an element of control. But there's always in a trade agreement going to be mechanisms in there which give the parties the ability to make changes should something happen in the future.
So the state aid issues that we've seen in recent years have been to do with steel coming from China being sold below market costs. That primarily impacts largely German steel producers, a lot more, who are the biggest steel producers in Europe. But of course, it also affects French and British steel producers. The other issue that you've always had as a bone of contention has always been between Boeing in the US and Airbus in Europe, where both sides give generous state aid to their airline industry, mainly through defense contracts. But the issues are not so much between the UK and the EU. It's largely between the EU and looking outside to China and the US as issues.
Yeah, it's very interesting because when you look at things globally, take a step away a little bit from the UK EU negotiations, you look at things globally, and there are some big trade pacts that are in place. You've got the Trans-Pacific Partnership, which the US decided not to join, but it's a very significant part. You've got the new economic partnership in Asia, which actually went into place in November. And that is actually about a third of the global economy is now wrapped up in that agreement. which, you know, is designed over the next 20 years or so to take away tariffs on about 90% of trade between those Asian economies. And in that, you're talking China, Japan, Australia, Vietnam, big economies. And I think the US know that they need to find allies globally here. You know, through Trump.
Do you think that's going to be a movement now with the Biden regime coming in, that they're going to pivot over and link a lot more to a similar economy in Europe to the US that will try and balance some of the Pacific Rim economies?
Yeah, it's very interesting. I mean, Richard made some, you know, great points about, you know, how the US is structured, the Senate and the House, and the decision making that needs to take place there when you're putting policy through, getting policy put in place. And at the moment, you know, the Biden administration, yes, they've got the House, but it's unlikely, you know, Richard said about 70%, likelihood that that's going to be a Republican-held Senate. And actually, you know, historically, when the Democrats have come into power, they've had both. They've had both the House and the Senate, and you know that's given them a much freer hand to introduce tax policy locally in the US. And actually, the Biden administration is looking to increase taxes here. You know, Trump administration, actually, one of their successes in my mind was actually they managed to take down a very high corporate tax rate in the US from 35% plus down to 21%. And Biden's looking to take that back up to about 28%. Initially, the Biden administration is talking about looking at their home sort of situation, clearly with the pandemic and having to deal with that and raise taxes. It will be quite hard to be a very outward-looking administration from the off. But there is soundings that they are looking to be more collaborative globally, and that should come over time. What that actually means and who they're going to partner with, they certainly sound like they're looking to make more inroads with the EU. Trump was never really a friend of the EU. He was a sort of advocate of Brexit. You've already seen with the Biden administration that as soon as they've come into place, actually, the UK have, pulled back from their breaking international law over the Northern Ireland Protocol, knowing that the Irish have a very strong friend in the US here. So we're seeing
very quietly swept under the carpet and very quickly agreed.
Yeah, absolutely. So, you know, you can't overlook the fact that this is a very significant change from a global perspective. Moving from a Trump administration to a Biden administration. It's going to be more conventional of what we've perhaps saw before the Trump administration, but I think they can see that the influence of China is a big one. You know, China is a growing economy, and they need to find a way to make sure that the US is, you know, trading strongly on a global basis.
So, our trade negotiations with the EU, according to the newspapers, are either about state aid, as the sticking points that is, are either about state aid, which I can't see as such a major thing. They're either about laws being passed for products in the EU that we have to abide by. But we've had 3-pin plugs for an awful long time. We still drink pints of beer in a pint, and we drive our cars in miles per hour, but we put litres of fuel in them. So we're a mixed up country of contrasts. We don't completely conform to everything that Europe does, and we never have done, really. So I can't see how that's such a big issue. And I also can't see how it could come down to just fishing. Sebastian's already told us that he didn't see any fishing boats when he went over to Ireland yesterday. So that side sorted out. They must be somewhere else in the North Sea, perhaps. But Sebastian, let me ask you, perhaps, you're a Frenchman living in London, which is an interesting scenario at the moment. Do you read French newspapers while you're in London? Do you sort of keep abreast of what's news in France? And how are the French news reporting what's going on, and do they see the whole of the crunch of this deal is on fishing?
I think we do. Yes, I do. I do read the French news. I think we lost a little bit of momentum because, as you said, all deadlines were extended. So we don't really see if it's going to be an ending story or no. And Macron is also quite firm, on going for a tougher position. And Barnier, I think one of the key things that the EU was negotiating, one of the first point was the position of Ireland and what happened with Northern Ireland and Republic of Ireland. And I think, as Nick said, one thing which is really important in the New Deal that we have with Biden is that Biden is really connected through his roots with Ireland. And I think there will be a kind of New Deal, a new way the US will maybe interact with EU and especially with Ireland. I think UK is a main client to France, so we have a lot of relationship with the UK. So nothing will stop, from starting on the 1st of Jan. Therefore, we see what we really see today on the news in France is what happened with the trucks in close to the channel where the trucks are and the border. So the queue, and they are building, those kind of parking. So everything is going to be extended, and there's a kind of like fear for people traveling abroad, but also for goods and how those things are going to process. And it's starting now. We see that every day on the news. So this is for us like a first visible output of what's going to happen with Brexit. So I would say that we talk about it, but it's a long story, and we talked for many months and years, and we lost a bit of momentum.
So when is Macron's election?
It's in 2 years.
So there's a lot of time to go between now and him being re-elected for the fishing issue to sort of get washed down the stream a little bit. And some people have talked about kicking the proverbial fish can down the road a little and talking about, well, let's agree fishing rights with France in UK waters over the next 5 or 10 years, monitor fish stocks, and if they start to decline, then use an argument about maintaining the fish levels to reduce fish quotas. But if this election is in 2 years' time, that's quite a long way down the line. I wonder if these negotiations are just going to continue on. Nick, can I come back to you to ask you one final question? And here's my real crunch question, I guess. And I'll ask each one of you to add a little bit onto this, if you like. If we don't end up with some type of deal by the end of this year, we've got 99% of a deal agreed, but if not all of it's agreed, none of it's agreed. So if none of it's agreed, then do we go into lots of mini deals? And ultimately, the big question is about import duties and tariffs. So if it's a deal between two countries and each one agreeing tariffs on each side, it's purely a situation where France or the EU on the 1st of January could say, right, as of today, we're going to be charging more import duty on goods coming in from the UK, at which point the UK would say, well, we'll presumably do something similar. But if there isn't a deal and nobody says, well, we're now going to charge you this new import duty level, what happens?
Okay, yeah, no, I'm happy to sort of think about that. I mean, I'm still very hopeful that there will be a deal here. And to some extent, I know you say, everything has to be agreed, but the question is, what is everything? As Richard said, people may expect that this could be a skinnier deal. The key thing really is to try and give the UK access to the single market. We really don't want tariffs here. If you look at the rate of those tariffs, they can go quite high. In sectors like dairy, they're up to 35%. That would clearly put a big cost on exporting goods into the EU market. The UK really doesn't want that. And you mentioned earlier, the UK has its own tariff book, its new tariff book, and actually a lot of tariffs from the UK, I think about 80% or so of the UK tariffs are zero. So a lot of goods coming into the UK, we will have our own sort of tariff book, but they could well be, low tariffs. But it's not just about the tariff. The tariff is one thing, but it's the ease of the movement as well. Clearly, if you have no deal, then you suddenly start to have checks. The agreement can cover more than just the tariffs. It would cover the level of checks that would take place on both sides. Clearly the sort of extent of documentation could be in there as well. So it is about trying to get as free movement of goods as possible, acknowledging though that there is a hard border there. We're not in a single market or the customs union anymore, so you do have to deal with customs procedures. But the trade agreement is trying to make that flow of goods as efficient as possible. And look, the UK has gone around the world here, and in a very short period of time, and this is full credit to the Department of International Trade, over the last 2 years, they've put in place 57 trade agreements. There are very few outstanding now. I think the big ones are with Mexico and Turkey. But most of the trade agreements with places like Japan, Canada, Switzerland, Singapore, big trading partners outside the EU, they've either got rollover agreements in place or they've perhaps got something slightly preferable. So the UK has done well globally in negotiating trade agreements. If we don't get one with the EU, and it is the big trade agreement for us, because about 50% of our exports are going to the EU, then I would expect that we'll be back to the negotiating table very quickly in the new year, because I don't believe, however much the government talk about being prepared to trade on Australia rules, Australia don't like their rules. Australia are looking for a trade agreement. Trade agreement really does ease the flow of goods, and therefore it will cause big problems in not having a deal, and we'll be back to the negotiating table pretty soon in the new year. If
we need a world without barriers.
Yeah, absolutely. So I'm hopeful that they will find a way of getting something in place. However, it may not be fully comprehensive, and they will probably add to it over the years as they start to identify some of the difficulties that are arising.
Richard, would you like to add anything on to that? I can lead you on by saying that when we started the discussions about leaving the EU, the rate of exchange between the euro and the sterling was about 1.5. Now we're down to 1.1, and we could be in below parity.
Yes.
That's a lot more than any of the import duty barriers we're talking about.
Yeah. So the like the heartburn list that we get from our our customers and we see from actual businesses, in my mind, must be mirrored in the EU, and there must be political pressure either side to get a deal done. And I totally agree with Nick. It's that I'm very sure we're going to get something at a revisit next year, because there's too much at stake. There really is. But this week we've seen good signs. We should be optimistic. I'm very sure something's going to get done.
Okay, Sebastian, what's the word from France, London, or Ireland from your perspective?
I just wanted to ask something on what Nick said from the fashion point of view. So customs, yes, there's a cost. There will be a different cost. There will be a higher cost, probably. And lead time will be a massive impact also, even for goods, samples, etc., moving from Europe to the UK in the case of Burberry. In Europe, most of the production is made in Italy. For example, if I take the example of Burberry, so it means physically the goods have to go, if we have prototyping stage, from factories in Italy to the UK, so they have to cross, the customs, so that will slow down. There will be another higher cost, and production is centralized in the warehouse in Newcastle, where everything is shipped from Newcastle. So as you can see, there will be cost and lead time impact. So what brands have already done, and especially Burberry, is to start moving into digital prototyping, as I explained before. So to cut cost and also cut lead time at prototype stage. And also something that we see is moving operations at headquarters to regions. So we have, for instance, in the case of bags manufacturing, we had a lot of development team, buying team, people doing all the costing, people doing all the fit of all those operations have moved to Italy to avoid back and forth of product and slowing down the process. And we were also thinking when one important phase in fashion is when you open the market. So when you have developed the prototypes and you offer your different products to buyers from department store, from different region of the globe, representing the brand. So they all meet up at a certain point in time to see the new collection and decide how much they want to buy of that. So to get those samples on time is always a rush. So we were already thinking, and Burberry is not the only one, to maybe transfer this operation that happened in the UK to Paris and rent a special location or move it to Italy or move it somewhere else in Europe continental where we have goods arriving on time easily. And sure, we will be sure that the goods will be there on time, even though we order them last minute. So there are a lot of things, a lot of implication on the daily activities in the fashion industry too.
Wow, wow, wow. And very interesting, very interesting. Nauzar, would you like to answer some of those or point out that more rupees are traded in London than the whole of India?
Which is true, legally that is. Okay. I just want to add a couple of key points here. One is this is about relationships, human relationships and a business relationship. And when as human beings, when we are, we know when we're on the precipice, we change. We start looking at things from the other person's perspective, and that's happening right now because I believe both parties are on the precipice. What I think will happen is we will get a deal, not the deal. We'll get a deal, and as Nick said earlier. And to add sort of a phrase to it, it might end up being a camouflaged extension, which will take the form of a period of maybe a year. By then, we know from real experience, in contracts, agreements are all subject to change. Clauses get changed based on realities, on outcomes. We know that from experience. Everybody else. If you have an employment sort of a contract in 6 months' time, if you do something or not do something, things can essentially basically change as well. So those changes, I believe, are going to happen over the next 6 to 9 months, potentially even over a year. So we're on the precipice. We change. We look at the other person's perspective. We will essentially, I think, go through at least till March with a camouflage sort of an extension, and everybody says, yay, we've left, which we will, but there will be massive changes on real operational issues as they rear their ugly or good heads.
I would like to say thank you all very much. One day I'm going to find the difference between NYC and RMB in China. Nick, thank you very much for sparing the time this afternoon to be with us. Richard, also thank you very much. Nauzar, co-host, you're a gentleman. Sebastian, I hope you enjoy your time over in Ireland. You've managed to escape lockdown in London. Congratulations. Have a lovely good week and have a great Christmas, everybody. Thank you all very much for joining us today. Really appreciate it.
Thank you.
Thank you all.
Thank you.
Thank you. Bye.
Thank you. Bye-bye.
Bye.
Bye.